All right, so we got the battle of the heavyweights here. We got billionaires Warren Buffett and Ray Dalio debating on whether you should or you should not invest in gold. Let's jump in first with Warren Buffett.
You had a shareholder who asked you a question about gold over the weekend, and your response was pretty interesting. Berkshire versus gold. You want to talk about how that's performed over the years?
Yeah, but we can go beyond that. But certainly, when we took over Berkshire, Berkshire was selling at $15 a share, and gold was selling at $20 an ounce, and then gold is now 1,600, and Berkshire's 120,000.
Now, great comparison there, and he's completely right. If you invested in Berkshire Hathaway $15, you would have made way more money than investing in gold at $20. But the problem is that Berkshire could have been a company that failed, and you could have lost all your money. Also, Warren is an expert. He's the best at finding companies at their early stages, going through their balance sheets and all their financial documents, making sure they're a great company surrounded by good people who are going to grow, and investing in them early on where he makes a lot of money. So a little different there. And again, you could have lost out entirely if you were even an average or above average investor by investing in the wrong company.
But you can take a broader example of that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it all kinds of things. But for 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end.
Now, that's great, but again, your average investor may not be able to afford 100 acres of farmland. Even for those of us that can afford it, like I could buy 100 acres of farmland right now. The problem is I'm not experienced in that asset, so I wouldn't know exactly what to do with it. So there'd be a pain process there where I'd likely incur losses for a good bit before I figured out the process. And it'll be a steep learning curve. It'll take a lot of my time to figure out how to profitize from 100 acres of farmland. Warren Buffett can easily afford that, and he can easily systemize it because he has a system in place and he's a multi-billionaire. So although he makes it seem easy, it's not necessarily that easy. Although he is right, 100 acres of farmland typically will outperform gold if you know what to do with it correctly.
100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400.
Now, this is a really interesting example. He's basically saying how you could have invested in the Dow Jones in 1900, made way more money, and get dividends throughout the time where if you invested in gold, you wouldn't have made as much. But let me point out a couple important things here. First of all, from 1800, where it was at 6, till 1900, where it was only at 66, that's only a 10 times increase there for the Dow Jones, right? And there's been times with gold, like in the 1970s, where it increased 25 times, right? And silver increased over 40 times in just 10 years. So that's much more than the 100 years of the Dow Jones throughout from 1800 to 1900. Also, the big increase from 1900 to 2020, wherever he's tracking from over those 120 years, a lot of that has to do with the Federal Reserve and all the money printing that's going on. So the Federal Reserve was created in 1913. We're taking off the gold standard in 1971, and then from there, it's just been printing, printing at will, where we're basically inflating the stock market. So although yes, the stock market has gone way up, there's going to be a time period here where it goes way down because what goes up must come down, especially when you artificially inflate it like we are by putting all this money into the system out of thin air like that. So that's a little knock to his comparison right here.
But you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time.
And I agree with him there. I think a good productive asset will beat a non-productive asset like gold. And he's saying non-productive because you don't get paid things like dividends and things like that. It kind of you don't earn interest off it. That's what he means by productive. But you have to be able to identify productive assets. Remember, he said a good productive asset. So if you're unable to do that like he is, or a specialized investor is, well, then your gold could actually be a much better investment. And there's other reasons to invest in gold and silver, right? It's a great hedge against inflation, and it's super simple. You buy it, and it can have huge gains, but over history of time, it's also protected because it doesn't lose its value like the dollar does or like fiat currencies do.
I think gold should be a part of everybody's portfolio to some degree because
it diversifies the portfolio.
I 100% agree with that, and I believe in diversification of portfolios. Now, typically, I invest in 5 to 20% of my portfolio in gold, but there's times when I invest more and there's times when I invest less. Right now, I'm typically going to invest more because I think a time is coming where it's going to be like the 70s, where it's almost like a gold rush. Now, the housing market. Right now, I'm getting out of the housing market, right? I'm taking that money and putting it more into precious metals. In 2008, when the housing market dropped substantially, that's when you wanted to go into the housing market. When it's at its highest, like it is right now, when stocks are at their highest, like they are right now, that's when you want to stay away from those and go into other assets that are lower.
Is the alternative money. We have a situation now where when you have too much debt leads to the printing of money to make it easier to service. So all of those things mean that some portion should be in gold.
Warren Buffett won't touch gold.
Okay, yeah.
You think he's wrong? Well, clearly you must.
I think he's making a big mistake.
I don't necessarily think Warren Buffett is making a big mistake by not investing in gold, but I think most people who are not investing in gold are making a big mistake. See, Warren Buffett, he's been around the block. He is an insider. He's a multi-billionaire, so he knows other hedges against inflation outside of gold, where he knows advanced tactics. So I don't necessarily think Warren Buffett needs to be investing in gold, but your average investor, like 99.99% of us, need to be investing in something like precious metals as a hedge against inflation unless we know those more advanced tactics and we're willing to pursue them and put the time and effort into them.
Yeah. Gold is like cash. It's an alternative version of cash. So over long term, it's not the best investment. Over long term, it's a little bit better than cash over long term.
And I disagree with him saying gold is kind of like cash. It's nothing like cash. Now, he was being general. He wasn't being exact. But I want to break it down to be exact. Gold is nothing like cash. The value of cash is basically people's confidence in it. And this, again, shows throughout history. When people lose confidence in a cash or in a fiat currency, as always happens 1,000 or 100% of the time, as it has happened for thousands of currencies, it eventually fails. And we're at that latter point of the process where money's being printed at an exponential rate where people start to lose confidence in it. And I can bring up a chart of our debt, and it shows from 1790 to 2022, it shows our debt chart. And you see most of our debt was created in the last 40, 50 years, and that's when we were taking off the gold standard. And actually, we have a little over $32 trillion in debt. $8 trillion of that was in the last 4 years alone. So a quarter of our debt has been accumulated over 230 years in just 4 years. So that means it's increasing at a faster and faster rate. So this has happened before many times in history. And again, this is the latter stages of a fiat currency failing, which has happened 100% of the time throughout history.
It says, however, when you're having a monetary crisis, when you have a fiat monetary system, and you have the need for money, debt is a promise to deliver money, right? So if you look at each of those devaluations that have taken place, March 1933.
By the way, March 1933 is when gold was outlawed, right? It was illegal to own gold in the United States all the way up to 1974. So for 41 years, it was illegal to own gold outside of little pieces of jewelry.
President Roosevelt closes the banks and then opens them and says you can get your money. And then they broke the link with gold. And so the history over that period of time is that money can be produced. Gold is somewhat limited. It's an effective. It's an alternative that should be part of everybody's portfolio, but not in a big way.
So what it means by that is like gold takes time to mine, right? Time, and that's huge because our currency right now doesn't take anything to be produced. They snap a finger, they put some numbers in a computer, and currency is produced. That can't happen with gold, and that's why the Federal Reserve did not want the gold standard, because they want to be able to print as much money as they can because they profit off debt. They profit off the interest payments. The banks profit, the politicians benefit because they don't have to directly tax the citizens for their agendas. They can secretly get taxed through inflation. And that's what inflation is. It's the secret tax from the government. So what he's talking about is basically the gold takes work to get, right? It takes time. You gotta find a mine. You gotta actually set all the infrastructure, set all the roads, all the structures. You gotta actually mine it. You gotta process it. It's like a 10-year process. Whereas money is just like that. And of course, there's limited gold. There's unlimited fiat currency because you can just create it like that.
Land, you can get somebody else to do all the work, give them a percentage of the crop, and you can sit back there for 100 years and get a percentage of the crop, and you still got the land when you get all through. I will guarantee you that farmland over 100 years is going to be gold. And so
well, tell that to the Iraqi. There's a comment down here, right? It says, I love this comment. It says an Iraqi had 100 ounces of gold in 2002. 20 years later, he still had that 100 ounces of gold. Can't say the same for his farmland or his whole nation. So tell that to the Iraqi. I like that comment there as I was reading through the comments. So although he says it's guaranteed, it's not guaranteed, right? It's a generalized statement. There's always risk involved.
equities.
Why do you think gold bugs get so irate? Because they really come out.
Yeah, it's very interesting. If you go on CNBC and say that bonds are kind of a poor investment, people don't get mad at you. You don't even hear from the Treasury. You can knock almost any investment, and people may get a little irritated. But when you talk about gold, and of course that says something about their motivations for ownership. They want people to agree with them. They want everybody to get so scared they run to a cave with gold. And caves might be a better investment than gold.
Warren Buffett's a comedian. Hopefully he was joking there. Caves are not a better investment than gold.
They're not producing more caves all the time. So they want people to be as afraid as they are, because that's what's going to produce an increase in prices. Incidentally, they're right to be afraid of paper money. I mean, they have their basic premise that paper money around the world is going to get worth less and less and less over time is absolutely correct. But
you just disagree with the investment theory beyond that.
Yeah. Where they run from that, and they should run from it.
Notice what he said there. Like, him and Ray both agree with this, as I do. You need to be running from paper currency. And if you aren't a super experienced investor that's aware of the more advanced tactics to run from paper money, or you're like a billionaire like Warren Buffett who knows how to run in different ways, well, then you better start looking at precious metals, because it's an easy hedge against inflation. You buy it, you hold it, and it can have huge increases like we saw with the 1970s. And I think that's about to happen as our currency is getting in more and more trouble. So just pay attention to that. We all think we should be running from the dollar. So where you run is just up to you. I just think precious metals are the easiest way to do it, unless you're a billionaire with super advanced tactics.
Is where, in my view, they make the mistake. But they have a correct basic premise.
And how one should actually consider putting gold in one's portfolio. Why do you think gold is now a good bet? Do you think a downturn is inevitable?
Well, first of all, I think every portfolio should have the right amount of diversification in it.
Great advice.
And so I'm going to approach the question as both a strategic asset allocation move to put gold in a portfolio, that I believe it always should be a certain part of a portfolio, because there's a certain environment that it diversifies the portfolio well, and a certain environment to worry about. I also think that environment is riskier, more likely, recently, now. And that environment is one in which it becomes very difficult to stimulate the economy, and there's a desire to depreciate the value of currencies. Now think about a bond is really the currency. So when one owns a bond or one owns a debt instrument, one is paid a pile of currency over a period of time. When there are a lot of obligations like that, a lot of debt, or even unfunded obligations like pension obligations or healthcare obligations that the world has, a lot of obligations, and there's not an effective monetary policy to lower interest rates and stimulate, as we're talking about, there needs to be the printing of money, the running larger deficits. We're going to come into an environment, I think, in which there are going to be larger deficits that are increasingly monetized.
We're already getting there. This video was shot about a year ago. We're already there.
That kind of an environment, the currencies are depreciated. That's an easy way to get out of paying your IOUs.
So just to be clear, you're
cheaper
expecting
money.
things to take a turn for the worse?
I think that in an evolutionary way, over the next 1, 2, and 3 years, that there will be a turn for the worse. Yeah.
100% agree, as Warren Buffett seems to agree as well, as he's telling us to run from paper money.
I think that there'll be an environment in which you're going to have excess capacity and debt restructurings and political issues entering into it. I think the elections that we're going to have in the United States will have an important bearing.
Yeah, we're not enthused about gold.
Now, Warren, you say you're not enthused about gold, but Berkshire Hathaway did buy 21 million shares of Barrick Gold, which is the largest mining company in the world, in 2020. So I'd ask you why to that statement.
People historically have felt that was the first refuge from a currency that was going to be decline in value. But so's a barrel of oil, so's an acre of land, so's a piece of Coca-Cola, so's See's Candy. See's Candy. If the dollar goes down 50%, we will be selling See's Candy for double the present price. Will be.
Okay, so did you hear what he just said? So if the dollar loses half its value, hell, I'll just sell my product for twice the value. Well, we're not all in Warren Buffett's shoes. We're in these major companies. Yeah, they can double their price as the dollar loses half its value. Most people aren't in that situation. So the thing is, a lot of Warren Buffett's points, although valid, they also go for like the upper tier, right? Like the billionaires who can adjust to the changes and know what's going on. Your average person is getting screwed.
We'll be getting the same real price for See's Candy. People will work the same number of minutes or hours per week in order to buy a pound or a 2-pound box of the candies.
The problem is they're paying twice as much. They're paying you the same thing, but they are paying twice as much because of inflation.
So we would much prefer some asset that is going to be useful, whether the currency is worth what it is today or 10% of what it is today, or whether people are using seashells in order to transact business, because people will go on eating and they'll go on drinking and doing various things, and their preferences will translate in real dollars.
Again, notice what he's saying is like, for me, things aren't going to change, right? As for Warren Buffett, like people are going to still keep eating, drinking. The problem is they're going to be doing less because they're going to be able to spend less through inflation over time. But for him, he's like, I'm still going to make the same profits because I'm just going to double my price if the dollar is cut in half as far as the value goes. So you need to understand, although all Warren's points are very accurate, they're accurate for him, not necessarily your general public.
More or less the same economics for us, and we would not trade the ownership of those kind of assets for a hunk of yellow metal, which has very little real utility.
That's not true. Come on, Warren. You know it's in a lot of electronics. It does have real utility. That's not true.
People who are looking to flee from the dollar and in our view, really haven't thought through the consequences of what fleeing would, where they should flee. Charlie?
Yeah, if you have the opportunities of Berkshire Hathaway, averaged out gold is a dumb investment.
Well, see what he just said there? If you have the opportunities of Berkshire Hathaway, average out gold is stupid, right? Well, yeah, if you're Berkshire Hathaway, maybe gold is not the right investment. For your average person, it's a lot different. We don't have the same opportunities as Berkshire Hathaway. Even for those of us who are millionaires, we don't have the same opportunities as the billionaires who have insider knowledge and super systems put in place where they can benefit from the system. So it's completely different, and he just admitted it right there. If you're Berkshire Hathaway, gold makes no sense. Okay, I can't disagree with that, but what about your average person?
My dad was a huge gold enthusiast, so I sat around the dinner table. My two sisters are here too; they will testify to it. We sat around listening to the virtues of gold, and that was in, we'll say, 1940. And gold at that time was $35 an ounce, and we would have had some storage and insurance costs. And here it is, 65 years later, world wars, nuclear bombs, all kinds of things, and the compound rate from $35 to a little over $400, less those expenses, is not something that causes me to salivate.
Now, obviously, the value is up near $2,000, not $400, so the increase is a lot greater than he's saying. But again, if we go and we break down this debate of Warren Buffett versus Ray Dalio, they're kind of debating different things, right? Warren Buffett's debating like gold investing for him, whereas I feel Ray Dalio is debating investing for your average person, right? Even for Ray Dalio, gold may not be the best investment because he has other options, being a multi-billionaire and having insider knowledge. But I think Ray Dalio kind of debated more for your general person. Even when I say general, I'm talking about your person who's below, below average to average to even above average, like your multimillionaire. Those type of people, gold should be in your portfolio. It is a hedge against inflation that can still have a big returns that has been tested against time. So if you want to find out more about investing in gold, we got links below. You can take a quiz to find a company. Tim and I can match you with a company. We have 20 years plus experience together in the industry. And you can also get the kit below, which gives you free insider knowledge on investing in gold if you want to learn more about it. Either way, both of these people tell you run from the dollar. If you aren't going to go into precious metals, make sure you educate yourself and run into something that's at least hedging against what's coming. Hope you all enjoyed this video. Remember, we have 3 videos come out a week on both investing in precious metals and the markets in general. Make sure you like, comment, subscribe to get those videos, and I'll see you soon.